Morning, everyone. Welcome to the new week in the macro snapshot. We are halfway through September, so it's September the 15th. It's Monday, and recording this in the morning as always. Let's kick it off with by looking at what's going on in Europe. Just interesting. One of the more sort of slightly hawkish members of the governing council of the ECB. Keep in mind that the ECB last week did not hike rates, and Lagarde said that they were in a sort of a good space, so to speak. So we have Schnabel here, as I say, just speaking literally as I'm talking here at about 7:30. So interest rates are in a good place. Monetary policy should keep steady hand. Okay, so ECB should tolerate moderate deviations from 2% goal. So it seems to be saying that they realize that inflation, may actually head up a little bit more. Upside risks to inflation dominate. There you go. Pass through from stronger euro to be limited. So they're saying that they're not sort of completely worried about the euro. Economic growth to exceed potential and domestic demand to counteract falling exports. Tariffs are net inflationary on supply chain effects. So it seems to be what we're just getting here, as I say, just having a quick look at these, is that Schnabel is basically saying that inflation could tick up a little bit more. Maybe some of that will be because of the sort of the tariffs, but it seems to be fairly upbeat on the European growth situation. So quite a positive outlook there. And that's just interesting because, the ECB had their decision last week. Obviously, this week we have a bunch of central banks, but especially the Fed. So we could start getting a divergence there in monetary policy. Also, what's kind of interesting is that on Friday afternoon, after the market closed, we had Fitch downgrading the French bonds. That was completely expected, and so there hasn't been a huge reaction. But let's just have a quick look and see what's going on here. So if you look at the French bonds here on that downgrade, we can see here that they are trading a little bit on the heavy side. But that's really not a huge sort of thing here. I think that's probably technical at this point. They might want to go down and retest this sort of triple bottom. But as I say, that downgrade was expected. What's probably more pertinent is actually the spread. And you can see here that the spread, it's not on its highest levels of 82, but it is sort of still hovering around that sort of 80-ish level. And so definitely there's a little bit of uncertainty premium being priced into that spread. In terms of the euro, we didn't get much of a reaction from the downgrade of France, but the euro here does seem to be looks as though it wants to be pushing higher, and definitely, well, I don't want to say definitely, nothing is definite in markets, but it looks as though it wants to test first of all this 117.85 level, and then maybe just the top of the range at 118.30, and it would not surprise me if it bumps up there a little bit and then maybe pushes out, especially if we get a slightly dovish Fed. We know the Fed's cutting, so that's kind of priced in. So it's going to depend a little bit probably on the press conference, on the statement, just the general sort of sentiment coming out of the Fed meeting. But if that is indicating, or if the market believes that the Fed is concerned about economic growth in the US, that could push the euro dollar up, which of course means that the dollar index, which we'll look at now, which is 57% euro, is trading on the heavy side. So you see the dollar index here still below all the moving averages. It's finding it difficult to get above the 50, even above the 20 here, and well above the 100 and the 200. So that trend is sort of pushing down. And again, kind of like the euro, looks as though it wants to retest down to, let's say, 96.75, so the bottom of its trading range. So we are starting to see a bit of a divergence there. And if we look at the spreads here, let's have a look at the spread. So let's look at the US 2 versus the German 2. And you can see here that this is really coming in a lot of tightening. So that means that the US 2-year yield is getting closer and closer to the sort of historically lower, or normally lower kind of German 2-year yield. And you've got to say at this point, just from a technical perspective, it looks as though 140 could be the target down there, which is still about 14 basis points. Now, I'm not saying it's going to happen, today or anything, but as I say, if the ECB, people like Schnabel and Lagarde basically saying that they're done for the moment in terms of cutting, that the European economy is doing relatively well, that inflation is still potentially an issue over there. And on the other hand, in the US, it potentially could be a bit of a slowdown, and the Fed cutting maybe 100, 150 basis points over the next 12 months. This differential could tighten up a little bit, and all things considered, that could/should be beneficial for euro versus USD. So that's the 2-year. If we also look at the 5-year, a similar kind of situation on the spread, although it does look as though it's getting to sort of a bit of a key level here, slightly a bit of a more resistance there. Just push this over here. And what's actually going to be interesting is to let's look at the 10s and the 30s as well. So see here, the 10s has come down a lot, but again, a bit more to go. And also the 30s. The 30s actually quite an interesting level there. That one could have a little bit of technical resistance here. So I'm going to put that on the chart, which I'll put my Nick box named for an excellent technical trader. Nick, if you're watching this, Nick, that's named for you. So uh, that looks like a level there. So what's happening here is that generally we're getting steepenings across the curves. We've had a bit of flattening recently. So if we actually look at some of the charts here, so let's have a look at the US. And when I say steepening, the overall what is going on here? Oh, that's the twos to the threes, not the twos to the 30s. So if we go on the twos to the 30s, you see that we have had a bit of flattening in the last few days, but overall the trend has been a steepening one. Now, interesting here, this is a pretty interesting point here. Those of you interested in getting into a steepener, because that's quite a nice technical level. Why is the curve flattened a little bit? There has been some sense that maybe the US economy is sort of slowing down and that the unemployment situation is worsening. And that would lead to, possibly this idea that, if the US economy is slowing down, less economic growth, that normally is going to be a positive for the back end of the curve, which will push down those yields. Secondly, an allied idea there is that, if the US economy does slow down, there may be a natural sort of disinflationary pressure. So that's going to depend on the data, but I personally think that overall, even if this comes down a little bit more now at the 50-day moving average, I think that overall the steepening is probably a good medium-term bet, just because of issuance. Because the other thing as well is that, let's say, for example, the economy does slow down. Okay, one can argue that's a flattener for the curve, and long-term yields may be coming down a little bit. On the other hand, though, that also means less tax receipts, probably more deficit spending because there's more spending necessary on social programs. So that's all of that's going to put a bit of long end pressure on the curve. So that could push upwards the long end of the curve, which would cause a sort of a steepener. And obviously, you have the front end of the curve being brought down by the Fed cutting. So the point is here is that even in a slowdown, or even a strong economic growth, we could get sort of a bull steepener or a bear steepener. And so I do believe that, now that the curve here on the 230s has come in, approximately, 22, 25 basis points has flattened. I think that's interesting. Well, let's see if that starts to steepen up a little bit more. Over in Germany, a slightly different situation, of course, in terms of the economy. But if we look at Germany, similar kind of situation that it did sort of steepen quite a lot, as you can see, all of this year, but it has sort of flattened a little bit. And it looks as though it's kind of plateauing out a little bit more. And that's just probably because the front of the curve, it looks to be, relatively stable at the moment in Germany. If anything, went up a little bit last week, just on a slightly more hawkish ECB. So if you've got the front of the curve stable, or maybe even going up a little bit, and a lot of the sort of deficit spending and whatnot is being priced into that curve. So I think that's maybe not such a good deal in terms of a steepener, although I have to say that that is also getting to an interesting level and is approaching the 100-day moving average. So interesting to watch those curves. While we're here, let's just keep on looking at gold. Gold looks as though it's just doing a very sort of shallow sideways consolidation. Lots of good reasons. Gold here just seems, if anything, sideways consolidation. Doesn't seem as though it wants to retrace. We have a weakening US dollar. We have potentially debasement of fiat currencies. We have a Fed which is maybe cutting into an economy where inflation could be slightly sticky. There's geopolitical risk. A lot of good reasons to be owning gold. I was also just looking at something this morning. A lot of the flows into the gold ETFs, they're really starting to pick up, which wasn't the case last year. So especially things like GLD, there's a lot of inflows into that. So that's really pushing up. And you can see something that's been reflected, that hunger for gold. Just quickly, if you look at something like the gold mining ETF, GDX or GDXJ, the juniors, I mean, absolutely ripping. Question here, can that keep on going? I guess so. But certainly from a sort of, stochastics and whatnot, it is sort of oversold. And one would expect that to sort of take a bit of a pause and calm down. But the reality is it's a very strong chart, way above all the moving averages. So people are looking around and saying, what can we sort of protect ourselves with? And gold does seem to be, it. Just while we're looking at that, also could be interesting to have a look at BTC. see what's going on there. Pretty interesting point here because this is a Fibonacci retracement here around about 117,000, and it looks as though it's stalling out a little bit. So this is pretty key here. If the bulls want to pick this up, they need to actually, if it comes back a little bit here, they need to pick this up and push this higher. Because for the bears, this is a pretty nice level here to be shorting. So it's interesting here that BTC is not acting quite as much as a safe haven or an inflation hedge or fiat debasement kind of story compared to gold, but still a positive chart. And those moving averages are not exactly going downwards. Right. So let's grab some tea here. I apologize. There's a lot of industrial noise outside. I hope that's not coming through on the video. Okay, so in terms of other things, we also have a huge amount of banking, a central bank action this week. So let's just have a look and see. Let's just see. We'll talk about that later in the week. So let's obviously start with the Fed. We have the Fed on Wednesday afternoon. So as you can see here, no surprises here. We know that 26 basis points is priced in. So a full cut is priced in. And if we look at the CME FedWatch tool over on the CME here, just to quickly have a look at that, that is, let me just bring that up. Where is it? You can see here that's 96.2% of in terms of positioning of the cut. A few market participants, maybe that's like a hedge, 3 or 4% of people thinking maybe there's going to be 2 cuts, and almost no one saying that they're going to stay on hold. So basically, no surprises if the Fed cuts. Really, the question is, could it be a 50 basis points? My personal view is I don't think so. I don't see what that achieves. It gives less flexibility to Powell and company. And so I think they'll go with 25. Obviously, I mean, we'll talk about that later, as I say, on Tuesday, tomorrow. But really, it's going to be about the statement and what Powell says, says in his statement. Does he think the economy is weakening substantially? How concerned is he about the employment situation, tariffs, all of this stuff, to determine the future pace of rate cuts. But at this point, it is interesting in terms of the stocks, because if Powell sort of takes a dovish tone and says that the real economy is potentially weakening, that the labor market is weakening, at a certain point, with the smaller profit margins of companies, you have to think that that could potentially be a negative for stocks. On the other hand, if he says the economy is great, inflation's a little bit sticky, but not hugely problematic, and then employment is just coming off a little bit, and they will keep on cutting. You could also argue, historically, when the Fed has cut into a relatively strong economy, that's also been pretty good for stocks in the past. So that's an interesting one to think about. We'll see what Powell has to say about that. Okay, so let's just look at a couple of other things. We also have the Bank of Canada proceeding the Fed at about 10:30, and it was at 10 o'clock in the morning. No, 9:45. Sorry, I should check that. I think 9:45. That's going to be on Wednesday. Again, in Canada, it was kind of an interesting one here because only 20 basis points of cuts are priced in. So the market is expecting sort of mathematically a cut, but it's sort of technically about 80%, as you can see. And that's based on the fact that the economic situation seems to be deteriorating in Canada. We had bad unemployment numbers recently. The GDP is down. A lot of the metrics there for growth in Canada are worsening, obviously, with the tariff effects. And you can see, there's a cost of living crisis in Canada. Everything's very, very expensive. And we saw over the weekend that Prime Minister Carney has established a new agency to build, with the goal of building a lot of affordable housing, and with an initial budget of about 13 billion. So obviously Carney is trying to come up with some big ticket items. We saw him last week talking about sort of, expanding LNG and pipelines and these kind of big ticket items, but also he's trying to sort of keep the political base happy, and sort of start building more affordable housing. So the point is that the Bank of Canada will be looking at all of this, and the market is pricing in an 80% of a cut. Will they hold and wait for August CPI numbers, August, one more round of numbers? It's possible. That's an interesting one. But again, I'll have a look at that a little bit more tomorrow. Later in the week, we have the Bank of England. As you can see here, at this point, they still have a relatively high sort of overnight rate, about 4%, a bit higher than some other developed economies. The inflation still seems to be a little bit sticky. The last meeting was a little bit of a hawkish surprise. And so as you can see here, the market really not pricing in any kind of cut, zero, as we can see. And if we go out all the way for, let's say, the next year or so, we've got just 1.5 cuts priced in. So a relatively hawkish, excuse me, outlook there for the Bank of England. And then finally, we have the Bank of Japan. Later in the week, we have that, I think, on Thursday overnight. I'll have to double check that Thursday overnight. And again, this is an interesting one. Not expected to hike. Now, keep in mind, everyone else is cutting. Bank of Japan could be hiking. There's a lot of political instability at the moment, choosing a new prime minister for the Liberal Democrats. Generally, my experience is that the history tells us that the Bank of Japan doesn't really like to do too many changes to monetary policy while there's political machinations happening. So I personally don't believe they will be hiking at this meeting. But then it becomes interesting will be the statement and what they say, maybe sort of guiding towards something towards the end of the year, maybe hiking. And as you can see, we've got about a 33% chance for October, and then basically a 2/3% chance by sort of the end of the year. So that's, excuse me, interesting there. So a lot of central bank action happening. The other thing as well, in terms of the politics of it, Lisa Cook, there was some information coming out that actually maybe she didn't commit sort of a mortgage fraud. Obviously, this is very political. Trump's administration has pushed the courts to deliver a decision before the meeting for the Fed starts tomorrow. So we're probably going to get that later today or even tonight, just to see whether she will be eligible to actually vote at that decision tomorrow, or whether the courts decide that she should step aside just while investigations are going ongoing. So I don't think it's really going to change the decision of the Fed on Wednesday afternoon, but nonetheless, in terms of the politics and sort of independence of the Fed, it's going to be interesting to watch the court's decision about Lisa Cook. In terms of other stuff, just want to have a quick look at oil, which is, where's oil? Where's oil? Where's oil? I think it's here. So there was talk over the weekends. The Russians continued to bombard Ukraine as the Israelis continue to bombard Gaza. So there's still sort of, let's call it geopolitical risk. And in relation to the situation in Russia and Ukraine, we have had Trump is apparently losing a bit of patience with his old buddy Putin and threatening to slap some sanctions on sort of Russian oil if NATO stops buying Russian oil, which is that's a complicated situation. Sorry, the noise here is incredible. I really hope it's not affecting the recording. It's hard to think with this noise in my ear. But what we are seeing here for oil is a little bit of support here. I think this is just geopolitical. As you can see, it's just 50 cents or $1. Nothing really structural. It's not as though oil's ripping on fundamental reasons here. And I think if the geopolitics were to sort of worsen, we could definitely see that testing back down towards the 61.50 area and maybe even pushing downwards. I think this is just being held up at the moment by market participants concerned that there could be some sort of upwards breakout if the geopolitical situation worsens. Just finally, guys, just as no particular data today, but what I want to look at is just the commitment of traders, just to see any particular movements here. This is just courtesy of Danske Bank. And you can see here that in terms of the stretched positions, we have the two so-called commodity currencies. We have CAD and Aussie. CAD remains very, very sort of oversold in a sense. And that's possibly, I mean, that's logical in a certain sense. The Bank of Canada potentially could be cutting. The Canadian economy does seem to be weakening. The Canadian economy does seem to be negatively affected by tariffs. So that's maybe not such a shocker, especially against some of the cross pairs. And for example, it could be interesting, something like short CAD, long euro going forward, depending on the relative divergence of their economies and monetary policy. We see the Aussie here was extremely oversold, but in the last week, there's been a little bit of buying here. And maybe that's because, Chinese data just, there is some improvement in the China situation. In Australia, the economy seems to be sort of hanging in there relatively strongly. So that seems to be picking itself up. It's still relatively oversold. Apart from that, everything else is in, relatively neutral territory. We do see Japan here. Everyone's very long Japan, probably even more so. You can see that the positioning move from this thin bar to this thicker bar. So now starting to, slowly get stretched a little bit long. And again, just based on this idea that the Japanese, the central bank, the BOJ, will be normalizing policy at some point. So let's keep an eye on that. And just finally, in some of the other sort of markets here, you see that oil here is, relatively neutral. That's not such an issue. Gold is the one which really stands out here in terms of, what we trade here. You see gold here is very, very stretched long. Can it continue to go? Yeah, yes, it can, because, as I say, there seems to be more ETF participation flowing in. Central banks continue, it seems, to buy gold bullion. So remember that stretch longs can continue. So it's not necessarily and obviously a short at this point, but it's just interesting to keep in mind that positioning there. Okay, I'll leave it there, guys, because as I say, I have a huge amount of noise outside the front window here, so I will leave it there. Have a great day, have a great week, and we'll be back with this tomorrow, maybe to talk a bit more about some of these central bank decisions. Thank you.